Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. In our first story today, we take a peek at the road ahead for India's electronics exports. In 2018, during the peak of the US-China trade war, Washington had imposed a 25% tariff on a slew of Chinese electronics products. While the move riled China, its similar competitors rejoiced. They saw an opportunity. Since then, nations like Vietnam, Malaysia, and Mexico have seen a surge in their exports to the US. India, however, seems to have lagged behind. So how can it catch up in the US electronics exports race? Debargia Sanyal's report offers an insight.
Over 4 years after a 25% tariff was imposed on electronics items it sells to the US, China still towers over other nations with about $178 billion of exports. But its electronics exports to the US have certainly taken a hit. It has come down by $29 billion in the last 4 years. This has offered a window of opportunity to its competitors, and countries such as Vietnam, Taiwan, and Malaysia, among others, have tried to make the most of it. But India, it seems, has failed to catch up to them. According to the Indian Cellular Electronic Association, or ICEA, India's electronics exports to the US in absolute terms went up by $3.2 billion in 4 years starting 2018, when the US imposed the duty on Chinese electronic goods. From $1.3 billion in 2018, it shot up to $4.5 billion in 2022, a jump of 350%. But was that enough? And how have other countries latched on to the opportunity? Vietnam experienced a surge in exports in absolute terms of $39.3 billion in the same period. The increase for Malaysia was $7.9 billion and for Mexico, $20.4 billion. In Taiwan's case, its electronic exports also went up by $30.5 billion in these 4 years.
All of these countries have strong export orientation economies. We're the exact opposite of that. We know how to attract people to do business in India. We do not yet know how to attract people to do business in India for export out of India. So there's a real mindset shift that needs to take place. It needs to take place in our whole industrial infrastructure. It needs to take place in our policy environment. It needs to take place in our logistics environment. And it needs to take place also in how we integrate with global supply chains and with trade pacts.
The ICEA says that while the increase in electronics exports to the US was 350%, it is insignificant in terms of absolute numbers when compared with these competing countries. So, why has India failed to grasp this golden opportunity?
We've never really had a serious electronics industry. We've struggled and tried for many, many decades. We tried during the era of serious import substitution in the 70s and 80s with no success whatsoever. And subsequently as well, we've seen other countries establish very strong export bases. If you look at the story of Malaysia and Vietnam, as a part of ASEAN, as a part of RCEP, they're very networked and very integrated with global supply chains, which is critical for electronic assembly.
If you look at the investment climate in these countries, at least at that point of time, it was better than India's. The policies were very, very clear and very easy for people to implement. So if a Samsung wanted to shift a whole supply chain or whatever part of their supply chain, it was almost no questions asked, come and start doing it out of Vietnam. Use Vietnamese land and Vietnamese labor and nothing else. Almost nothing else was being used. And however, in India, we cannot do that. And I agree with the government there because we are a much larger market. So the period under review that you're talking about, 2018 to 22, was a period where I think we were in a transition. We did not have the supply chains before that to be able to do some of those goods that were required in the US. The last bit is about components. Of course, there our supply chains are still not strong enough to be counted as exporters.
Based on an analysis of the duties imposed on certain Chinese items, the ICEA has identified the key electronic products where India should take the lead, given its manufacturing and exporting capabilities. These include flat panel TVs, set-top boxes that have communication functions, wireless communication apparatus, and lamps with glass envelopes that are used mostly for cystoscopes and other surgical instruments. Besides focusing on specific electronic products, experts also believe India's electronic exports need more essential and systemic changes.
We're seeing the first signs of the growth of an electronics assembly and electronics manufacturing business, which are quite encouraging. The key thing that will determine whether or not this is successful in the long run is if a good backward integration local supply chain starts forming. So if the component manufacturer starts to develop also, that will start to breed a wider, more competitive ecosystem for electronic assembly in the long run. We will only be competitive if we can draw on the most competitive component manufacturers. But then we need to find ways of really getting those supply chains on a competitive basis, not on the basis of protection.
Our plug and play infrastructure is still not in place. So if somebody wants to come and set up, it still will take him a long time from land, building, or even if he goes into a leased factory, it's at least a 1-year stretch, and that's too long in our business. The second bit is where I think policy reforms are required, the changes are required, and that is in the area of components. So far, we have been able to crack the piece of assembly or manufacture in product lines where we have a protection tariff for domestic markets. So at the moment, exports is a secondary objective of most businesses in India. If we want to get the kind of numbers that these other countries got and exceed them, we have to make export our primary objective. And then, nobody wants to do EMS in India when all the components are still going to come from China. So let's get the components into India, which I hope this PLI 3.0 or something like that will come.
The central government, meanwhile, approved the Production-Linked Incentive Scheme 2.0 on May 17th for IT hardware with a budgetary outlay of 17,000 crore rupees. This scheme covers laptops, tablets, all-in-one PCs, servers, and ultra-small form factor devices. Minister for IT and Telecom, Ashwini Vaishnaw, said the scheme is expected to lead to incremental production of 3.35 trillion rupees, incremental investment of 2,430 crore rupees, and create incremental direct employment for 75,000 people during the scheme's period. The PLI 2.0 is a clear sign that the government is aware of the need for greater incentives in the sector, and experts believe that electronics exports are catching up. It grew a whopping 50% in FY23. However, they stress a serious rethinking is needed, especially when it comes to incentivizing the manufacturing of components in India. Most importantly, the sector needs a complete regulatory overhaul with a corporate mindset so that companies can prioritize export as a primary goal.
Twitter is all the rage right now, like it has always been. and it has been rife with controversies since Elon Musk took over. He had fired almost 50% of the workforce, including its CEO, Parag Agrawal. He also privatized Twitter, and now Musk has appointed Linda Yaccarino as the new CEO. So will she tick the right buttons and restore sanity at Twitter? Tushar Verma has the answer.
Tesla and SpaceX CEO Elon Musk is known for his controversial tweets, and there is no stopping him after his takeover of Twitter. In a recent interview, he reiterated that he will continue to express himself unfiltered even if his tweets scare away potential Tesla buyers or Twitter advertisers. As Musk stays unfiltered on the microblogging site, Twitter's new chief executive Linda Yaccarino has her role cut out. Among other challenges, she needs to restore trust with advertisers and bring them back to the platform. Linda Yaccarino is a familiar face in the advertising industry. She has been the head of advertising sales at NBC Universal, the American multinational media giant, before accepting Elon Musk's offer. And that's significant because Twitter has seen an exodus of advertisers, even at its top tier. Elon Musk upended Twitter following his dramatic takeover of the platform. Musk changed the concept of the blue tick verification system. Previously, it was an editorial judgment. Now, anybody can get a verified account by paying a subscription fee. Musk's divisive leadership also led to a series of layoffs in Twitter. Its workforce was reduced from 7,500 employees to 3,700. More recently, Twitter mislabeled scores of news outlet accounts. Amidst these disruptions, we asked brand strategist Harish Bijur of Harish Bijur Consults if the new CEO Yaccarino brings back some sense of sanity in Twitter.
I do believe, Twitter needs a CEO who's totally hands-on. That's essential because, Mr. Musk has a particular style, a particular approach, and he's done his task and his role in terms of acquiring Twitter. I think his approach was radical. His approach was sudden. It was actually backfired. And I think it's time for the new CEO to take a look as to how these actions could be corrected and how Twitter monetizes its appeal.
With reprivatization of Twitter, Musk bought back many accounts which were banned by the previous management because of platform norm violations. This included former US President Donald Trump. Twitter has been also facing the ire of various regulators as well. Amidst layoffs, it shut down its Brussels office, which was interacting with the European Union regulators. Twitter received a warning from the US Federal Trade Commission in November last year, wherein the Commission had cautioned that no CEO or company is above the law and companies must follow FTC consent decrees. So, with a new CEO in place, what steps should Linda Yaccarino take to mitigate the sour relations with regulators and investors?
The problem with the takeover of Twitter by Elon Musk was that Elon Musk tends to be a cowboy. By adding Linda, he's bringing somebody from NBC who comes from an environment which is more corporate, more process oriented, and so she will bring some calmness to the organization, which badly needs it because the employees are very uncertain because they don't know any day what is going to happen, what is Elon going to do, who is he going to fire. So they are going to be reassured that finally there is somebody who knows how to work within the constraints of a major corporation.
And the microblogging site is yet to recover from the impact of advertiser exodus. The Wall Street Journal had reported that December earnings of Twitter declined by 40% in revenue. More than half of the top 1,000 advertisers on the platform had stopped advertising as of February 2023. Furthermore, relations with advertisers that make up 90% of Twitter's revenue have not seen significant improvements. What can Yaccarino, with her advertising experience, do to improve revenue collections and win back advertisers?
The reason she probably got hired is she has some of the best connections you can have to advertisers. She's worked at NBC for a long time managing advertisers. She's probably on first name basis with most of the heads of major advertisers. The question and the challenge for Linda is threefold. First is, can she manage to constrain Elon Musk when he owns the company in a manner that will be more palatable for the advertisers? Can she protect Twitter from his worst instincts? So we will have to see how they come up with some kind of power sharing, decision-making sharing, so that in some sense they get the best of her while getting the entrepreneurial energy of Elon Musk. Second, she's going to have to reassure the brands that this is a change place and that she will manage it in a way that is conducive to their best interest. I think on that front, she can probably do a good job if she can manage to solve the first problem of managing Elon Musk. The third thing which she needs to do, for which I don't think she particularly has skills for the moment, and that is manage the technologists at Twitter, because in the end, Twitter is a technology company very high on coders.
Experts believe Twitter under Yaccarino can see improvement in corporate governance in the months to come. During her term at NBC Universal, she oversaw sales and advertising across cable, digital, and broadcast platforms. Whether she will be able to turn Twitter profitable remains to be seen.
While the Twitter saga will continue, let us see what is exciting the investors in India. The real estate sector has been on investors' radar. Institutional investment in the sector jumped 37% to $1.65 billion during January-March quarter, driven by higher inflow in office and housing properties. The related stocks too have given a stupendous return during the period. So will the sector and the stocks continue to remain a favorable bet going ahead? Lavisha Darat finds out in our next segment.
India's real estate sector has remained an attractive bet among foreign institutional investors in the past 6 years. A recent report by Colliers suggested that between calendar years 2017 and 2022, FII investments in realty rose threefold to $26.6 billion as against the preceding 6-year period. This move was reflected at the bourses too. Shares of DLF, Godrej Properties, Oberoi Realty, Prestige Estates rallied in the range of 170 to 304% as against 172% rise in the S&P Realty Index and 128% gain in the S&P BSE Sensex between 2017 and 2022. Analysts underline strong end consumer demand, ease of business operations and competitive costs to be key reasons behind the rise in FII flows. Going forward, they expect the real estate sector to remain dear to FIIs in the medium to long term.
The real estate demand would continue to remain strong because we are seeing increased levels of demand for Class A properties on the leasing side, as well as good developers are seeing fairly strong traction on the residential real estate side. Post Q4, we believe we could see upgrades in the listed real estate stocks because of strong consumer demand. Some of the regions where we are seeing strong traction include Mumbai, Delhi, Hyderabad and Bangalore.
In the January to March quarter of FY23, realty majors DLF, Godrej Properties, Oberoi Realty and Macrotech developers clocked up to 106% year-on-year jump in consolidated net profit, whereas growth in revenue from operations ranged between -6 and 23.7% year-on-year. Carrying strong order book forward, managements of realty developers have guided for a positive FY24, estimating a 15 to 20% rise in the sale booking value. Therefore, analysts recommend selectively buying stocks in the sector over the next 12 to 15 months. Ronald Sioni of Sharekhan says,
"We expect the realty outperformance to sustain over next 12 to 15 months as the companies have a strong launch pipeline for FY24 while they continue to scout for new business development additions. Further, even after post the recent run-up, most of the stocks are still trading below their net asset values. Our preferred picks in the sector are DLF, Macrotech, Oberoi Realty and Sobha."
On May 18, market trends will be dictated by the last batch of Q4 results, global cues, foreign flows and crude oil prices.
While Indian markets are looking up, the European stocks, meanwhile, stumbled yesterday on May 17th. Wall Street banks and asset managers are on the edge. But why? Believe it or not, the United States of America is staring at a default. Its leaders, including President Joe Biden, are holding meetings to avert it by raising the debt ceiling. But what is a debt ceiling? Raghav Agarwal explains. The US government may soon run out of money unless it allows itself to borrow more. On May 16th, US President Joe Biden met the US House of Representatives Speaker Kevin McCarthy to resume negotiations to raise the debt ceiling within reach. A failure of the US government to meet its debt obligations may trigger a global financial crisis. But what is this US debt ceiling? The debt ceiling is a law that limits the total amount of money the US government can borrow to pay its bills. This includes paying for the military, social security, and federal employees, as well as the interest on the national debt and tax refunds. The US debt ceiling is currently capped at $31.4 trillion. The limit was breached in January, but the Treasury Department used extraordinary measures to provide more cash to the government. Earlier, US Treasury Secretary Janet Yellen said that without additional borrowing, the US would not have enough money to meet its financial obligations from June 1st. Why was the ceiling imposed? The ceiling was first imposed in 1917, allowing the US Treasury to issue bonds and raise money without congressional approval as long as the total falls under the debt ceiling. The ceiling is imposed to keep a check on the spending by the US government. In several years in the past, including 1995, 2011, 2013, and then in 2021, political disputes have risen on the Treasury advising the Congress that the debt ceiling is about to be reached and a default is imminent. This year too, it has become a political flashpoint. President Biden had to cancel his Quad meeting, which was scheduled to be held in Australia. What happens if the ceiling is not raised? If the ceiling is not raised, the US government cannot raise more money. It will not be able to pay salaries to federal and state employees or pensions to pensioners in the US. Moreover, companies that depend on the government for funds cannot borrow more. The US government may also be unable to pay the interest due on its debt, putting the country into default. The last time the US entered a default was in 1979. A long-term impact of the non-payment of interest would be that investors will start seeing US debt as risky and raise interest rates. This could trickle down the economy and make all types of borrowing costlier. According to a report by Moody's, if the ceiling is not raised, the US stocks may fall by almost a fifth, and the economy may contract by up to 4%. This may also lead to a loss of 7 million jobs. The US, however, has not breached its debt ceiling to date. What is the 14th Amendment? Some people have also urged Biden to invoke the 14th Amendment in the US Constitution. It states that the validity of the public debt of the United States shall not be questioned. Biden said he was considering it, but it may lead to a legal battle. Yellen said that it may spark a constitutional crisis. What's next for the US? In April, the Republicans forwarded a deal to suspend the debt limit by $1.5 trillion or until March 31st. They proposed that, in return, the spending on key agencies can be kept at 2022 levels during the current financial year. However, they will have to repeal incentives in certain areas, including tax benefits for electric vehicles.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hope our explainer on the debt ceiling cleared your doubts on what is going on in the US right now. Also, very few know that the default that the US faced in 1979 was due to a glitch in word processing equipment, which led to a delay in payments of treasury bills. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.